Hello and welcome everyone to this panel on the art of sustainable investing. My name is Charlie Donovan. I'm a visiting professor of finance at the University of Washington, and I'm joined by four individuals who are going to talk about the challenges facing the industry around ESG. And it's a real important time. I think we all recognize that ESG has taken a lot of flack in recent months. People asking about what it represents, whether it's a financial risk, a non-financial risk, somewhere in between, and fundamentally some questions about, is this one big cover for greenwashing by the industry? And so these are the kinds of questions we want to address that speak not to just how ESG portfolios are constructed, but what does ESG mean to non-green portfolios, and how do we ultimately get to the mainstream in finding factors that make sense for all investors that represent the real concerns around things like climate change and natural capital. So with that, let me just say who these panelists are, and we'll dive right into the questions. Marco Tarico is a partner at Bluebell Capital Partners. Ines McKeon is head of strategic equities at USS Investment Management, a firm that's managing my pension, so I'm very interested to find out what he's got to say. Andrea Blackman is the global head of Moody's ESG Solutions, and Ana Rivero is global head of ESG and investment content at Santander Investment Asset Management. So with that, Marco, let's dive right in. And I understand your firm takes an activist view, work as would be called an activist hedge fund. And maybe to kick off, you could just tell us, what does ESG mean in the context of the investing that you do?
Thank you, Charlie, and thanks for inviting me to the panel. You're right, we are a fund that pursues what we call an active engagement strategy, and we very much incorporate ESG into everything we do. In fact, ESG is one of the four criteria that we utilize to look at interesting investment opportunities, the other three being strategy, operational improvements, and capital structure. Within ESG, G, let me say, has always been and is our bread and butter, but also E and S have been more and more important over time, and today they are, let me say, equally important. What do we do? Well, first of all, what we do is, as I said, we incorporate ESG criteria when we analyze and screen companies. Without going into detail, we do a first primary analysis, we call it, based on internal data, and then we do an enhanced analysis, also with the help of an external consultant, mainly to identify the critical risk factors or the critical controversies on which then we decide to focus when it's the opportunity arises. But secondly, and probably most importantly, at least for us, is the second level of what we do, which is the real engagement with the target companies. And this, I believe, is a differentiating factor from a number of other investors. We tend to take a very pragmatic, concrete approach. So we like to look under the hood and really focus on key aspects. And we can do that in relation to an investment that we have in the portfolio, whether it's a long investment or it's a short investment, or sometime we have done it and we plan to do it once every couple of years, what we call a one-share ESG campaign, where we effectively do not have an economic interest in the target company, but we engage into an environment, social, or governance campaign to prove the point, maybe a little bit, let me say, in a provocative way, that when it comes to these topics, we are all stakeholders, and it doesn't really matter how sizable your holding is, because we're all entitled to speak and all entitled to ask questions.
And Marco, your firm has had a fairly high-profile campaign with Solvay, and I wonder if you'd talk us through a little bit what your objectives have been in that campaign.
Sure. This is a very interesting situation where we are currently engaged. It's a situation where we have identified a specific plant of Solvay, which, as you certainly know, is a major a global chemical company with presence in over 100 countries. One specific plant where they produce their traditional product, which is the soda ash, and where they discharge the solid waste of this production directly onto the shore and directly then into the Mediterranean Sea. The funny thing is that given that soda ash is as a product is white and therefore also the wastes are white, they have created an artificial beach which sounds like a Caribbean beach that is in the Mediterranean, but it's still a major environmental disaster. And we have therefore been campaigning for over a year now with Solvay, and maybe we can discuss this in more detail later, where we've effectively asked the company either to clean up the shore or to apply the same technology that they use in all the other plants where they produce soda ash globally, which is through the creation of settling ponds where the water goes and then is treated but is not discharged into the sea.
Mm-hmm. Good, thank you. I have more questions for you on that, but let me get around to our other panelists first, and we'll come back. Andrew, I wonder if we could kick off with you, because there's a lot of talk out there. Every time you ask somebody or you ask a firm, why aren't you doing more on this? And they say, it's data. Data is, it's kind of this story that everybody falls back to. So I wonder, tell us about where this is headed in terms of data. Moody's has been investing a lot to capture more data, to try to do more analytics. So maybe you could give us some insight into where that's all headed.
Sure. Data is the baseline for all of this. I mean, in order to make informed decisions, investors need decision useful data. And that's been a really big challenge in the context of ESG, in part because disclosure is really variable and there haven't been standards. There are standards emerging, but they can vary by jurisdiction. And then it becomes a question of what stage is a company at and what are they disclosing and how comparable between one company and another are those disclosures. Up until now, what the ESG data providers have been trying to do is basically go for volume. And on the basis of volume, you can create benchmarks and offer some sort of screening indicator for an investor or a bank or a corporate to use in order to evaluate relative performance. What we're finding, though, is that in the absence of clear data definition and clear disclosure requirements, you can get really hard to interpret outcomes. And so what we're doing at Moody's is we're investing in deep domain expertise, but we're also stripping things back to basic principles in order to start with very clear data definition, make sure that it's tagged up well so that it aligns to different standards, giving people the ability to filter for different investment strategies and themes, making sure that there's clear transparency around methodologies and putting the information that people need into their hands. Now, that doesn't solve the whole problem because, as I said, disclosure is a rare commodity. And so in many cases, you're having to proxy and you're having to use predictive analytics in order to score companies. And you're also having to standardize. And so what you're dealing with is one of the big data sets that are out there, and you're having to use artificial intelligence, machine learning to pull this information in. You're having to pull from multiple documents, and then you're having to index and store it all. I think the good news is that real progress is being made. We certainly feel like we're getting to the stage where we've got quality data that's reliable and importantly traceable, but gathering the coverage that the market needs in order to have the choice of investment is really difficult. And then there's a huge amount of qualitative interpretation to a lot of this stuff and subjectivity, because what is good to one person might not be deemed good to another. And so you have to just have very clear processes and standards that you apply so that people clearly understand what the data means and what the measures and metrics that you derive from the data means.
So let me ask you a bit more about that, because clearly, as this industry has evolved, it was clear that we had a bit of a dog's breakfast going on out there in terms of very low correlations between different provider scores, and the reaction was, we need standards. But in your view, who should hold those standards? Because there is a real risk as well, is that of misalignment of capital if one entity says it should all look like this and they turn out to be wrong. So is it governments? Is it academics? Is it who should be making these standards, and then how would that play into the vision that you just set out?
That's a really interesting question. I think it depends on what you apply the standards to. So I think there's a movement in the industry among policymakers to try and impose standards on the methodologies for scoring. And I don't think that's where the standards belong. I think we need disclosure standards, and I think we need international harmonization so that at the source, we know that an apple compares to an apple. I think, though, given the state of the industry and the very different perspectives that are being brought to bear on this, you need to demand transparency in terms of scoring methodology, but you don't necessarily want to apply a standard to how things are scored, because I think what you'll end up doing is squashing innovation in a stage where people don't necessarily know what the end game is, but they know what the information they require is to do what they want to get done. And so I'm very supportive of disclosure standards and alignment to standard bodies that are getting industry consensus build up around them for the important aspects we should be focused on and measuring. But I'm not necessarily supportive of standard methodology for scoring, because it gives different constituents in the market the ability to use the data and indicators for the purposes that they specifically want to pursue, as opposed to something that would be defined centrally, which could potentially miss the mark in many instances.
Right. Good. Thank you. I've got much more to come back to you on that, but let me move on so that we get a first take from everyone. Ines, now we bring into the perspective of a large asset owner, and clearly some different pressures on you. And I've seen it firsthand, where if the fund doesn't deliver, you get teachers that walk out of their offices and go on strike. So these are the different kind of pressures, and you have to be really sure that when you're going to introduce new factors into the way that you value companies, that better be well grounded. So I wonder if you could just talk us a little bit through that process, specifically around valuation. Do I want to buy or sell this name, and how ESG integration has been working for you?
Yeah, it's a significant challenge for us and every other asset owner who looks at things through a kind of fundamental investing lens. We're really trying to grapple with how do we build in a carbon price. Sustainability is a highly complex area. We're trying to focus on a number of key priorities. Climate change is clearly right up there. And how do we price carbon in fundamental models is a challenge we're grappling with. How do we build scenarios into our work? We have to think about it, not only our assets, but our liabilities, and even the strength of our covenant under various climate scenarios. We frame some of the broader ESG issues in the fundamental teams by using kind of SASB type data to frame the issues, but really we're in the throes of trying to figure out how we build in a carbon pricing scenario and how that impacts on DCF valuations.
Mm-hmm. And where do you think we're at in terms of, there's a whole community of, first they were CSR specialists, then they were responsible investment, and now we're into ESG, and I'm sure there will be some new acronym that comes up in the next few years, which begins to dominate. But there was always specialists. Clearly, this is becoming the domain of generalists as well. And how do you see that working? Is that working, where that specialist knowledge is bleeding over into portfolio managers who maybe haven't thought about this much at all in their careers?
Yeah, I think there's a real learning curve. Even just getting investors across the lexicon, the terminology that's used in the responsible investing or ESG space. So they've got a massive learning curve. I think we're going to have to try and figure out how we address that. I see the need for both training, internal and external, but also just to get us up the learning curve to bring in external expertise. even on that narrow issue of carbon pricing? How do we get good insight on that? So it's a real challenge. I think up to this point, responsible investment teams or ESG teams have typically been, not an island into themselves, but they've been somewhat disassociated from the actual business of investing. We're going to have to work really hard to integrate them, bring the expertise in, and I think in the end, the investors will need to own this. But there's many challenges to get to a point where we can say they truly do and then know what to do with the information they've got.
I mean, my own hypothesis is that as soon as the financial evidence is there, these things can happen very quickly. And to that point, what we saw in the UK is when the Bank of England introduced a stress test on those banks, almost overnight, a lot of the activity went from a sustainability group within the bank to the risk function. And that kind of transfer of responsibility was really indicative of the kind of attention that the organization felt like that it needed to give. So, Anna, maybe I could use that to come to you. And for a large asset manager tied to a bank, maybe talk us through this journey of, you're in the position of having to say that you understand these issues in order to attract money under management. And what has that sort of journey been like for Santander?
Yeah, you're right. I mean, we are in a position where we are in the middle of this ESG revolution. We have clients, we have retail clients and also institutional clients, and we act as providers, but also we are principal actor in the mainstream investment community, because we are almost focused on every little aspect of this, as I say, revolution. I was really happy when I saw the name of the panel, because it is an art right now. Sustainable investment at this stage, it is an art. I hope that it will become just mainstream and everyone will know what we're talking about and everyone will know how to invest in a sustainable way. But right now, to combine all the different departments and most of it in a bank that are involved and have a say in what ESG investing is really, really an art. We started investing with some ethical criteria, and those investing in some support programs and IT back 25 years back, but it was just a really, really minority business in the asset management firm. But as everyone in the last 6 to 10 years, it became really a necessity. And right now, SFDR, what has brought to the European asset managers is a timeline. It's a necessity that has deadlines and has something to comply with. It's not only faith, it's not only volunteer, it's not only that you believe in the right way to do things and the right way to invest is integrating ESG factors, but you also have the regulators right now in forcing you or pushing you to come to the agenda with just your decisions on that, and mainly when the next year you will have to ask your clients in the suitability test if they really do want sustainable products in their pipeline of products. No, so it involves right now all the organization. We have a team, an ESG team that is embedded in the investments team. So that it's we were just listening from my colleagues right now. That it's a necessity that everyone understands and is in the same page. It's not only risks, it's also opportunities. So you have to put all the organization to work on the same page. And what I say always is the main challenge that we have is that everyone understands why we are doing this. I mean, we are not doing this because it's a regulatory issue. We are not doing this because it's a trend. We are doing this because we believe the community and mostly the clients believe that this is the future of investing. So every investment that you do in your own resources, allocating your money into teams, into data, mainly data providers that we all need, it's a building for the future.
So let me ask you a bit more about that. And Ines, I'd also like to ask you to come in on this question, because when I saw the title of this panel, I was a bit worried, I have to say, because when I saw the art of sustainable investment, I thought, boy, there's a thing that my finance professor colleagues just hate to see, because they would like to see it to be the science of sustainable investing. And in a lot of ways, 2 years ago, if we'd been doing this panel, we'd be advocating for, we believe that there's financial issues associated with ESG factors, and that integration needs to occur. In a lot of ways, we seem to be in a slightly back foot now, in which there's a lot of talk about, is there a bubble in ESG, or is the industry, has it gotten ahead of itself? And the real evidence on the ground is that there is a fundamental re-rating going on in various industries due to the perception that some of the assets that they're holding are not going to be as valuable as people thought they were. So Anna first, and then maybe Anna second. Just where do you think that we are? Are we still too far behind in terms of the market expectations of what is going to play out, or has the industry gotten a bit ahead of itself?
Well, I would say it's a combination of both. We need more clarity on regulators and rules, mainly, and laws and definitions, and we need more granularity on data. We need more availability to this data, because data is not magical. I mean, it doesn't grow in trees. I mean, if we need data, then corporates have to deliver this data. But if, for example, regulators in Europe are asking asset managers to disclose some data relating to the ESG investment, that should be the same requirements for corporates to deliver this data, because if not, you are just that is where the art comes and not the science. I mean, science comes with numbers, but when you don't have all the numbers in place, you have to do your estimates, you have to do your best efforts, best practices, and this is where the art comes into place. But we are asset management industry is way ahead of many other industries because of the regulation that, as I said, forces us to invest and to have some in-house resources dedicated to that. But I'm pretty sure that in the next 2 to 5 years, this is going to become more a science than an art.
Ines, talk to us about valuation. Where do you see things today?
I think it's pretty hard to argue that it's in the price when some industries like thermal coal are still operating. We know they're not going to survive in the new world at some future point. So do I think it's in the price? I don't think it is, but again, that's a judgment based upon the art of it. It's a sense of it rather than the actual numbers in most cases. So I think it's a bit of a challenge. I mean, we're being pushed by government and regulation to do lots of things. There's a massive load upon institutions like ours in terms of reporting. That is kind of running ahead, I think, of the doing of the real stuff, the integration of ESG and sustainable investing into investment processes. So that's a bit of a concern to me, but I think we're a long way away from having gone too far, both in terms of what we actually do as investors and what we do as in terms of the regulation.
Great. Let's stay with this, but Marco and Andrea, I want to bring you into the conversation, because there's been also one of the criticisms that seems to be building up and that I hear a lot is, if the industry is really successful in getting this kind of data capture, analytical coverage, and implementation, then could there be a very perverse effect where we just push people out of the publicly listed markets and into private markets? And certainly there have been some transactions already that seem to indicate that indeed that would be the case. So I wonder if you'd talk a little bit about, are we setting ourselves up for an arbitrage between public and private markets, and what needs to happen in terms of data and analytics in the private markets to ensure that doesn't happen? Marco, maybe you could take that first.
Charlie, we only invest in public equity. I have experience in my previous working in private markets, but we only invest in public equity. So maybe Andrea is better suited than me to reply specifically on the private market. Maybe I would like, I've taken some note, and I fully share Andrea's comments earlier about the need to have a qualitative interpretation of the data. We are we receive a lot of data. There are we are inundated by data on ESG. By the way, I would argue that these are three so important and so broad topics, E, S, and G, that it would merit a separate discussion, because E is very different from S and very different from G. However, what we really need to do is really look under the hood, as I was saying before. Just I give you a couple of examples going back to my case of Solvay, previously mentioned. And Andrea, this does not want to be controversial, but just slightly provocative. But when you look at the rating that Solvay had with MSCI, it was rated AAA. Okay, and by the way, in discussions we had with MSCI, after a few months of discussions, they downgraded Solvay to AA. Now, is it because of our action? I'm not sure, and I wouldn't be that pretentious to affirm that. But what I'm trying to say is that for us, the way we invest, a company, for example, on the environment is as good as the worst of its plans. Not, we are not going to do averages, and we're going to ask them, to correct what we see as a malpractice. Another example, we have had conversations, with CDP. We're talking about water here, and I can tell you that we've received the data that they have collected from Solvay, and we found out that the withdrawals did not match the consumption and the discharges. So it's a simple sum to do, but there was a big difference, between these data. So what I'm trying to say is that it is truly important, in my opinion, to receive, collect as much data as possible, but then you need to look really into the specificities. When you talk about water, we would argue that you need to do an analysis that goes plant by plant, region by region. You cannot simply do a mean of what a company does. It would be too simplistic.
Andrea, so let's take that challenge. Is the future of this industry to where, asset level data is available for every asset on the planet, and when we, investors and analysts can aggregate that at the firm level, and that's fundamentally, are we looking at a real possibility of that depth and breadth of data availability coming forward?
I think it depends on what you're trying to evaluate. I mean, certainly in the case of physical climate risk, I think we need to get down to asset level data, and we need to understand at a fairly granular level what the productive output of that physical location is, because otherwise it's very hard to evaluate what the risks are. And we're currently doing a good job of it. We've got 2 million physical locations scored on 2,500 corporates, and that coverage is increasing all the time. But getting down to the specificity of where they are and what they do and how important are they to the future health of the company is incredibly difficult. So I think, it all comes back to data. It comes back to good quality data, so that the people who are investing, the financial services firms that are operating in the market, have something they can rely on to look to begin to make their judgments. And I think you raised earlier, Charlie, the topic of the Bank of England stress tests. As more regulation is imposed, and Anne, I'll come to the SFDR regulation shortly, but in the case of the Bank of England stress tests, we were very engaged with them on what is it you want to test. And of course, it's the systemic resilience. And then what will the first set of tests demonstrate? And they weren't going to name and shame. And really what they wanted to do was make it real for the systemically important banks and say, start to pull together your data. We're going to look at how meaningful it is and what we believe the gap is towards you knowing and equally us knowing what it is we need to do to manage for transition and resilience. And I think all of the efforts that are taking place in the market right now, both from a regulatory perspective and other policy considerations, are about trying to make this relevant and real for the companies, for the financial services, and for the capital allocation that everyone's trying to bring to bear on the objectives of the Sustainable Finance Action Plan. And one of the things that we're discovering, because Charlie, earlier you were asking me, there's so many different approaches and different data providers, and Marco's been talking about how much data is out there, but how much of it is useful. One of the things that I've got a lot of focus on is how do I make the data sets that the different market participants are using coherent and related? Because the risk we face is that we allow different perspectives to produce data that the market participants grab in the absence of anything that they can rely upon. And there isn't a connection between Anna's asset allocation, how the bank is focusing on risk, and what the corporates are actually disclosing. And I think it's got relevance both in the public sector and in the private sector, because if we allow the reallocation of assets out of the public sector because there's greater scrutiny and an objective that we're all pursuing, and we let it all flow into the private sector, we're all living on the same planet, and that's not going to solve anything. So I know you didn't pull up that bit of the question again, but if you want to talk more about how we tackle private sector, then I'm happy to talk about that too.
Oh, unfortunately, we're going to run out of time on this discussion, so I just want to do one lightning round here to close. We've got just a couple of minutes, but building on this theme of going from art to science, would ask just each of you if you could just offer one indicator that would help us know that this is becoming real, that we're moving into a space in which ESG integration is becoming really part of the mainstream and really fits within the let's say or shapes the traditional mindset of investing. So maybe, Ines, I could start with you. What's one thing that for you is, and I'm sure you get a lot of pitches from different asset managers saying that they understand this space. What's one indicator that they mean it for real?
I think you've got to just show that this is part of every conversation that you have with the companies that you invest in, that you talk to management about this thing. Usually investors talk to management about the fundamentals, how's the strategy going, how much money they're making, all that good stuff. But where is sustainability and conversations with management? What are they disclosing? What's your plan to transition to net zero? And hold them to account on that issue.
Great, thank you, Marco. One thing that would make it real.
There is nothing that we do that is not unreal. We always do things very pragmatic and very real. As I said, I really don't care if a corporate kind of hides behind a buzzword, okay, about saving the planet. I start from looking at a specific plant, and I want to have all the answers about that plant. Sorry if I go back to Solvay, but it's again an important case for us at the moment. In the last AGM of Solvay, a month and a half ago, lasted 3 hours. For 2 hours, the management kindly answered 25 questions on that specific plant that we have sent in advance. So that to me is have an impact. That to me is making a difference, having the company focus on that specific issue and try to address it.
Super. Sounds like a great proof point. Anna, at Santander, what does it mean making it real, going from art towards science with sustainable investing?
To me, it will be when science is a commodity, when data becomes a commodity that everyone owns or everyone has access to and everyone is able to understand, then we will value and customers and clients and investors will value the art of the interpretation of data. Let's just put that as that happens in financial data from decades. We all have the same financial data from all the corporates, but some people decide to buy, others to sell, others to hold the position. But the data is for all of us is the same. What changes is the interpretation of data. Then you need data to be mainstream, and then science will be mainstream, and then you will start valuing the art.
Super, I like that. Thank you. Andrea, I'll give you the last word on this one.
Thank you. So I don't want to repeat what Anna said, but going on from what Anna said, I think we need standardization and harmonization of international standards so that we can get disclosure rates up and people can tackle this in a very systematic way. And then we can start to put into the hands of the practitioners the information they need in order to make their choices about where value is and where resilience is realized from.
I think it was Warren Buffett that famously said that he did not see himself as an investor. He saw himself as an artist. So maybe as we pass from art to science, we'll end up back at art again. But let's just see how that cycle goes. And there's a lot more conversations to be had to map out what are those next steps. So I just want to thank all of you, Marco and Ines, Andrea and Anna. Thanks very much for joining this panel. And thank you to The Economist for hosting the conversation.